Investing in the stock market can seem like a daunting endeavor, especially for beginners. However, it's a powerful tool for building wealth over time. Stocks represent fractional ownership in a company. When you buy stock, you're essentially buying a tiny piece of that company. Companies issue stock to raise capital for various reasons, such as funding expansion, research, or paying off debt. By selling shares to the public, companies can access the funds they need to grow and thrive. This, in turn, can increase the value of the company and subsequently the value of your shares. Investing in stocks allows you to participate in the growth of these companies and potentially share in their profits. It's a long-term game that requires patience and discipline, but it can be incredibly rewarding. Remember, knowledge is power. Understanding the basics of stock investing is crucial before you begin. The first step to investing in stocks is opening a brokerage account. A brokerage account acts as a gateway to the stock market, allowing you to buy and sell stocks. Numerous online brokerage platforms are available, many offering user-friendly interfaces and helpful resources for beginners. When choosing a brokerage account, consider factors like trading fees, account minimums, research tools, and customer support. Once you've selected a brokerage, you'll need to fund your account by transferring money from your bank. With your funded account, you can begin browsing stocks and placing orders. You'll specify the company you want to invest in and the number of shares you wish to purchase. Similarly, when you're ready to sell, you'll place a sell order through your brokerage platform. It's important to remember that investing involves risk. The stock market can be volatile and prices can fluctuate. However, over the long term, stocks have historically provided solid returns, making them a valuable component of a diversified investment portfolio. There are two primary ways to make money from stocks: price appreciation and dividends. Price appreciation, also known as capital gains, occurs when the price of a stock rises above the price you initially paid for it. For example, let's say you purchase one share of company XYZ for $50. If the company performs well, its stock price might increase to $75. If you then decide to sell your share, you'd make a profit of $25 per share, excluding any trading fees. Dividends, on the other hand, are payments made by companies to their shareholders, typically from their profits. Not all companies pay dividends, but those that do distribute a portion of their earnings to shareholders on a regular basis, usually quarterly. Dividends can provide a steady stream of passive income for investors and can be particularly appealing to those seeking regular cash flow from their investments. Section 4. Different strokes for different folks' investing styles. There are various investing styles, each with its own approach and risk tolerance. Long-term investing involves holding stocks for an extended period, often years or even decades. This approach focuses on the long-term growth potential of companies and aims to benefit from the power of compounding returns. Trading, in contrast, involves buying and selling stocks frequently, often within short time frames, to capitalize on short-term price fluctuations. Trading can be highly risky and is generally not recommended for beginners as it requires significant time, knowledge, and expertise. Speculating is another high-risk investing style that involves betting on the future price movements of stocks, often based on speculation or rumors rather than fundamental analysis. Speculation is highly speculative and can lead to substantial losses. For most beginners, long-term investing is the most suitable approach. It emphasizes patience, discipline, and a focus on the underlying fundamentals of the companies you invest in. The Section 5 Essential Tips for Beginner Investors. Navigating the stock market can be overwhelming, but here are some practical tips for beginners. Start small. You don't need a fortune to begin investing. Start with a small amount you're comfortable with and gradually increase your investments over time. Focus on learning. Take the time to educate yourself about the basics of investing, different investment strategies, and how to evaluate companies. Choose stable companies. Look for well-established companies with a proven track record of profitability and growth. Do your research. Before investing in any stock, thoroughly research the company, its industry, its competitors, and its financial health. Be patient. Investing is a marathon, not a sprint. Don't expect to get rich quickly. Be patient, stay disciplined, and focus on the long term. Remember, Investing always carries some degree of risk, and the value of your investments can fluctuate. This information is for educational purposes only and does not constitute financial advice.